Well, welcome everybody to the February 2017 edition of the Roundtable. We're squeezing it in on the last day of the month in February, and it is our 7th annual Roundtable Awards. The people pictured on the screen are our regular knights in addition to guest knights and damsels that have joined us over that time frame. And so they could be mentioned at any point during the way, and they're all certainly welcome to participate to their heart's content. This has been an interesting trek over the last almost 8 years. We've had a lot of fun trying to share some ideas and demonstrate some analysis and basically just have some fun. And that's what tonight is about, just have some fun and make a few more stock picks and share some ideas. So let's get the legal paperwork out of the way first. This is an educational demonstration. No investment recommendation is intended. We do this for education. We do it to illustrate and demonstrate the types of things that we see done in the modern investment club movement, the understanding and awareness of companies, focusing on the things that we've been taught are the most important over these past 70 plus years by the champions of the modern investment club movement, and that's what we're doing here. We may actually hold some of the positions in real money accounts, so we always try to say when that is the case, but again, the most important thing is do your own homework. This is all about education. Here's our agenda real quick. It's our standing agenda that we go through. The only thing different is tonight we are going to spend just a few moments on the best, the picks over the last year and looking back over the last nearly 8 years. The 4 selections that are towards the bottom of the page, Cy Lynch will be presenting EPAM. Kim Butcher is unable to join us, but she has thrown out an ETF, ticker symbol CSD, that we'll talk about a bit. And I'm going to present Synaptics. Ken will come back with MEDNAX. And if Hugh joins us, he may have one to throw on the pile, but it's kind of tough to tell. Again, he's traveling. Again, he's always traveling. And I kind of hope he can join us because we're going to be talking a bit about him and his ears will be burning extensively. On the upper right is the Punchki from Michigan in celebration of Fat Tuesday, the end of the Epiphany season and the beginning of Mardi Gras and the season of Lent. And if you're familiar with the Michigan tradition, I don't know how worldwide it is, but
it's very regional, Mark. Very regional.
Very regional, really.
Yes, it is.
So did you consume a few of these today, Ken?
We had punchkis today. Yes, we did.
So you're out running around. You had to make the stops and do this.
Yeah. They're really nice, plump jelly donuts, essentially, folks. But they come in all kinds of flavors, and they're a wonderful treat to have once a year on Mardi Gras.
And they're not low-cal or on any diet plan that I'm aware of, so I managed to avoid them for the most part.
They didn't send you one on your diet food plan there, Mark?
No. but in the interest of honoring traditions, one of the things I will share with the audience, many of you in the audience probably know the former editor of Better Investing magazine was Don Danko. Don Danko would go down to Hamtramck, Michigan, and basically come back with arms full of boxes of punchkis to share with the Better Investing staff, and he did that every year. He's continued to do it over the years. I don't know whether he did it today or not, but he has been a stickler for that tradition over the years. So again, a big welcome to those of you who may be new. We do keep this fairly informal. Ken will be watching and monitoring for questions. We do at the end, after the audience poll, open the floor for questions and answers. And again, we welcome your participation in the poll and anything that's on your mind. Here's just a quick reminder of what this is about. We started doing this on a monthly basis at webcasts like this for nearly 8 years now. We are trying to share legitimate favorite ideas that we think have a better than average chance of beating the market and working out to be successful. Again, there are no guarantees in this stuff, but we do try to pick some good stuff and beat the long-term market by 5 percentage points. And we'll talk a little bit about that. We would like to see the majority of our selections actually beat the market. We track every investment, every decision made versus a mirroring or tracking investment in the Wilshire 5000, and then we say how many actually beat that. Here's a look at our results over the years. You can see we had kind of a sluggish start in that first year, year and a half time frame, and just kind of caught fire there as we hit that second year. I'm glad we didn't give up and surrender. Some awfully good ideas came out of that second year and third year time frame. We are beating the market by about 1 percentage point. The actual absolute rate of return is 12.6%. Again, that's stacking up all, I think it's about 400 transactions now, stacking them all up and calculating the rate of return of that, just like you would for an investment club portfolio using the software. About 50% of our picks have beat the market. That's actually a fairly decent number. An average investor achieves about 30 to 40%. And again, our target is to beat the market by those 5 percentage points or 500 basis points. To do that, we'd have to get up to that red line, and we see it as something that could happen someday. We believe that it is possible. It's not the end of the world to end up between 0 and 5. In fact, it's not the end of the world to end up slightly negative when it comes to measuring the relative return of any effort in investing. Again, the average investor tends to end up at down in that -4, -6, -8% range. So again, that's what we're attempting to outperform, leaning on each other's ideas.
Mark, I think sometimes we need to celebrate another number also that sometimes gets lost when we put this chart up here. You're right, our goal is to beat the market by 5 points, but for almost the entire, well, this is a rate of return for the entire time we've been doing this, and we're coming up on our 7th year now, and if you look, the rate of return over those 7 years has been 12.6%. I would challenge anybody in the audience to talk to me about an investment that they've made, especially an investment that covers a lot of different things, not just a single stock, that's returned them 12.6% since the beginning of the investment almost 7 years ago. Sometimes that large number gets lost when we say we're only beating the market by 1.25%, 1.5%.
Yeah, it can get lost in the translation, and it is a fairly formidable performance. Here's a quick look at the most influential, the largest holdings in the tracking portfolio by percent of assets. What we do is every time a decision or a selection is made, we invest $1,000 into it. So in the case of Cognizant Technology, that's been chosen about 12 times. $12,000 has become $18,000 over the period tracked. And you can see from top to bottom there the top 20 most influential positions in the portfolio. We're not going to spend a lot of time talking about selling tonight. We're going to return to that subject next month as Ken and I fine-tune our relatively better selling stuff for the National Convention. But just real quickly, we look at 3 major criteria in the design and maintenance of any portfolio, the first being the return forecast on the far right. And at 10.1, you can see that that's actually in pretty good shape compared to the market. The average stock right now has a return forecast of about 5%. So 10% is actually pretty good. Quality is strong. That's typical of any group of investors in the modern investment club movement coming together. We very rarely see a club or a group of people that are investing in the weaker companies. And these are all top quintile or pretty close to it, good or excellent companies. And the overall average is quite strong. The only one that needs a little bit of work, and that always seems to need a little bit of work, is that growth column in the middle. That's the weighted average sales growth forecast for the holdings in the portfolio. We'd like to see that in the 11 or 12 range, and it's just a slightly a little bit under that at 9.9. So again, as we make our selections, we should be biased towards some of the smaller, faster growing companies as we do. Any comments or observations about any of the companies on the chart, either Cy or Ken?
We gotta love Cognizant.
Gotta love Cognizant?
Although I haven't picked it in several months, so you'll...
Well, you're sort of picking it tonight.
Well, I figured you would accuse me of that. I do note, did notice that Priceline had a significant, they were up 5 or 6% today. I'm not sure whether they reported or what
They
exactly
they
happened with it.
reported today, Cy. They had a wonderful earnings report, and they were up a little bit more than 6% at the end. Is what the last number I looked at. Almost $100 a share. They were up. I like to look at this list and pick out those 4 or 5 or 6 stocks that have only been chosen 2 or 3 or 4 times. There's some stocks on this list that have doubled and even tripled since we've chosen them, and we haven't chosen them for a lot of times, but I focus on NetEase, for example, about, I don't know, 2/3 of the way down the list right there. I think it's only been chosen twice, and it's worth, at least double, maybe better than double. And you can do those same kind of things if you study hard. The only lament I have is that sometimes we find really good stocks. Universal Display is another one, OLED, that we haven't chosen a whole lot. It's worth $10,000 today, and you just wonder why we didn't come back to it and get stubborn about it like we did about some of the ones near the top. So.
Yeah, in fact, Universal Display is an example of one that you and I picked and the audience voted for it, so it's a 3-time selection. $3,000 has become that 10,000.
Yeah.
That's one of
And
the, we'll see that in a minute.
Yeah, and actually, Ken, I've taken your lament to heart and tend to just about every month try and take a look at some of those lower pick stocks and see if there are anything that I want to repeat.
Yeah, I've been doing the same thing, Cy. I've been looking back at some of our ones that I was really, quite impressed with, and then didn't go back to them. eGov that I chose either last month or the month before is another great example of something that we've only chosen 2 or 3, maybe 4 times. There it is sitting, and it's almost worth $8,000 now. So
And
you can do this, folks. You can do this.
One of the things I think we should underscore, we usually spend a lot of time, especially when any of us are out there in the world teaching in a face-to-face class. There's 3 or 4 companies on here with asterisks after them. That means they're not in the Value Line Standard Edition. And it's just a reminder that companies like Mesa Labs, Ken was just talking about eGov, NetEase, those smaller, faster-growing companies are an extremely important part over the long term for the portfolio, and we should never stop seeking them, and just evidence that we have. And again, if you want to check into the guts of there's about 100 holdings in it now in the tracking portfolio. That dashboard or that link up at the top of the page is public. You can actually take a look, and there's actually a legend there that will tell you how many times some of these have been chosen. We're going to be talking in a minute about Bank of America, Caterpillar maybe a little bit, but Bank of America for sure. That's one that has been chosen 5 times by Hugh, and Bank of America has been quite rewarding, especially here over the last several months. So, good stuff. Many Hugh McManus picks on this list for sure. Is he with us yet?
One thing before we go on, Mark, I noticed that Kay comments that NetEase has a PAR of 4.6 and OLED 5.2, and just an observation that that's exactly what you would expect to happen when you have a company do what Ken is talking about. Remember that price and return, all things remaining equal, go in opposite directions. They're inverses. So if you have a company that gives you outsized return, you're going to expect the PAR to go down. So you may not be wanting to buy it right now, but Ken's point was we were buying it back when the PAR was higher, and we're now being rewarded for it.
We typically would go into a portfolio-driven discussion of looking at the ones that have the lowest return forecast and kind of putting them on the hot seat. We'll certainly do that next month as we look at the portfolio. The average conditions circled at the bottom mean we don't really have to pay too much attention to that right now. And we would if any one of these was negative. But
yeah, I would also tell you that those two stocks that you mentioned, NetEase and OLED, are not necessarily buys today, but if you do some deep diving into NetEase, there's not a value line report, there's not a Morningstar report, there's not even a comprehensive S&P report on it the last time I looked, but the analysts that do follow NetEase are all over the board. It happens to be a Chinese company. The information is sparse. It only tends to report twice a year, although occasionally it gives a quarterly report. It's not required to. And you can come up with some really different valuations and some really different par numbers depending on where you think NetEase is going to head in the next couple of years. I know a lot about the stock because it's one of the largest holdings in our model club. We've held it for about, maybe 8 years now, and all we've ever done with it is cut it back. When it gets up to be 25-28% of our portfolio, we sell a little bit of it again. And then when it goes up $35 in one day like it did recently, then we come to the next meeting and we smile and we look at each other and we ask ourselves, why the heck did we sell any of it? You know. So I think we're ready to continue, Mark.
Okay, we'll keep pressing on here. All right, we're going to take a break for a couple minutes. Normally we spread these out, but we're going to put them all together. We are talking about our annual awards, the Golden Knight statuettes. They're only cyber statues. We couldn't afford the postage to send them all to Pasadena for McManus. And we have actually subtitled this one, He's Going to Need a Bigger Wheelbarrow, because he has continued to dominate over the last several years. Here's the first category. We're just going to kind of rip through these guys. Step in if you see anything that really reaches out and grabs you. This is the best stock pick over the last year, and for 2016, it's Bank of America, Hugh McManus, and much of that is within the last couple of weeks or the last month or so. I was winning until just a few weeks ago with Stifel Financial, and he did manage to pass it up again. I will point out, and this is where Si, you can take your first bow of the night. Look at the number of mentions on there for you. You know, this was a good year for Mr. Lynch.
I'm bowing, even if you can't see me.
Given the cyber bow, huh?
That's right.
And I believe the IPG Photonics you actually selected at the National Convention. Is that correct?
I believe that is correct, yes.
And that has turned out to be pretty strong, and the audience is definitely along with you on that ride. So all the dates are there. Again, any one of these selections, you can see the date of the roundtable session is the purchase date. The ones that are color-coded or shaded in, Stifel and Nordstrom. By the way, that Nordstrom is a real stunner for me. I don't typically have these things work out that well. To buy and sell Nordstrom last year and make that type of a return on it. I know a lot of you were skeptical about that, and deservedly so. So that actually shows a couple of closed positions just even within the last year.
I think we need to focus, Mark, on what that last column, again, just explaining it to everybody so that they can ponder it for a moment, what it really means. That's not the return, that's the relative return. What that means is that this Bank of America stock did not return 77%. It returned 77% better than the market, which has been doing fairly well, returned. So, you know, the total return is the column one in, and that's the number you really maybe want to focus on if you want to ask yourself, how well has that stock done in the last year? Our modest goal is to beat the market by about 5 points, and we're looking at a set of stocks here that have beat the market by a minimum of, what, 18 points there? Am I reading that number correctly there? Yep. So these are really superior performances out of this group of stocks.
Yeah, good stuff top to bottom. You can see the history there. And what's kind of fascinating is Hugh's won everything else around here for the last 7 years, 6 or 7 years, and he had never won this category, so I guess he decided he had to have this one too. So we can lament that. So the next category is best selection all time, and again, we'll just kind of whip through these. Again, on the strength of Bank of America here in the last few months, that is now the all-time best pick. You can see that's on the heels of Amazon a year to go. Yes, that's the Amazon that he picked in a standing room only audience and got no votes for, so we all can take the blame for that one. But you can see, again, the slide that was just up there was just the last year. This is actually the last 7 years. We were just talking a few minutes ago about the OLED, Universal Display. There it is right there. A 3-time selection that evening, April 2014, and that one's performed pretty well. So good, clean fun. Again, I had this category until he took it away from me in the last few days. So such is the world with Hugh McManus. As far as the best picture, this is one that we've just kind of taken a moment out to acknowledge. Sometimes it's been a presentation about from Hungary all the way over to China when it came to pulled pork back in 2010. Hugh's timeless contribution of Spock and Kirk. That one is definitely worth going back and taking a look at. Cited a presentation on Teva. Anyhow, it could be stock related. Matt Spielman's stroll across the parking lot on Air Lease was a masterpiece. You guys have always told us that these are a few of our favorite screens as one of your favorite presentations from us, but the one that we got the most feedback by far, very positive feedback, was on the relatively better selling and the exploration and open-minded quest that we're on when it comes to that topic. And again, we'll be back on that next month. So those were some fun presentations over the years, and Ken and I will take a bow on that one. Again, we like to pick things to beat the market. That's what accuracy is about. When we say a pick is accurate, that means it beat the market since selection. I actually take home the 2016 award with 8 out of 12 actually beating the market. This is becoming my favorite category, as you can see. I kind of like to win some of the other ones too, but it's having some fun. And again, all time, Hugh sneaks in there and takes this one too. The performance of his stuff in Bank of America and Caterpillar and Deere and a few others, they all turned around this year and make him into quite a formidable adversary and a very valued contributor to this forum. It'd be just nice if he could land. He does so much traveling because of business that he's had a hard time joining us in several of the recent months. Any comments on any of these guys?
Well, that doesn't happen very often when nobody has anything to say, Mark, so just go on to the next
Just
slide.
keep pressing on and get to these.
Yeah.
So I want to talk about this one, best performance in a leading role. He actually takes home the award for 2016. He had the best performance of anybody involved. And again, the people involved include the guest damsels like Kim and the audience. And he had a pretty strong year, and that does not yet include the BioVerita spinoff. So it actually is a couple percentage points higher than that. And I'll let you explain the picture on the right, Cy.
Oh yes, that is our fall trip to Disney World, and I believe that is the Mount Everest roller coaster in at Disney. Actually, it's at Animal Kingdom, and you go backwards through the dark, and then you get to come down, and we're just coming into the light. And life is a roller coaster, and as you can see, my roller coaster has peaked in 2016, apparently, with relative returns. I'm kind of surprised with that good a year that I fizzled on the previous category and let Hugh sneak by me on accuracy, although I suspect that Cognizant kind of got it. But that's, I guess it's for those of you who don't know, the top 2 people with their hands up is Barb, my wife, and I, as I said.
Size in the red shirt, yep.
Roller coaster.
And Ken and I were talking before we got started about this is kind of a neat category because everybody involved in this has taken home the top prize for different years. And Ken had a particularly spectacular 2013, and again, McManus was dominant in the early years, but you can see size picks down there at the bottom from top to bottom, some outstanding selections. Some of those are still a work in progress, but some good stuff there. All right, and the last category, and again, he's not here to accept all the heaping praise. We're thinking about giving Hugh a Lifetime Achievement Award, send him off with his wheelbarrow full of statuettes and let somebody else win this thing. Now, we're here to, we welcome his contribution to the team, and we want to try to keep up with him. And he's got the best performance over the long term. He has beaten the market by 4.6 percentage points. That places him at about 17 or 18% for a rate of return over these past 7 years. And he does it with a blend of very carefully vetted, high-quality companies that his basically his favorites, in combination with stuff that's playful. And I'm using a very diplomatic phrase. Sometimes he can get quite playful with companies, and he's had some success doing that. So he's got his core, but he also has his non-core adventures. And again, we just give him congratulations, and he needs a bigger trophy case.
And he is a good example, although he's had some good early years, as you can see back in 2011, and I believe also on the previous slide for highest relative return annually, he had some early years that were good, but he is a prime example of patience paying off.
Oh yeah, his picks on Bank of America that go back now 6 years or so, just amazing.
Right.
And he's got more like that. All right, here's just one transitional slide before we actually get into the stock presentations. We'll kick it off with Cy here in a minute. Sometimes people are curious about our groundhog contest and some of the people that actually show up here making presentations. This is just a look at a 10-year contest. And again, it's a stock picking game, but anybody who's done it for 3 years or more is eligible for this list, where we actually list their annualized return, compare it versus the Wilshire 5000 benchmark, and then rank them from top to bottom in terms of market beating. One of our favorite ones to scratch our heads over is the Broad Assets Investment Club out of St. Louis. They have a spectacular return, 30%, 34% per year for 5 years that they've been in the contest. Now, some people can get hot for a year or two. These guys have been pretty hot for quite some time. They've actually won the group contest 3 out of the last 4 years. You can see some of the other people that participate in this contest. One of the other things that I would like to point out, Bauer City's on there, Sirius qualified this year, Nick Strategos' club out of Pittsburgh, the Mutual Club of Cheney, Spokane. And then if I had just a little bit more room, just barely off the chart, there's a collection of investment clubs, not individuals, investment clubs that are just on the borderline of breaking into this list. We really hope they have good years participating here, because the ratio of individuals to clubs is probably about 9 to 1, and it's just fascinating to me to watch these investment clubs, trickling in and basically cream rising up this list, because it's quite a field of individual entries also. And again, many of the people that you hear from on this program represented on this list. All right, so that's just one more long-term perspective thing, and we'll switch gears, and Cy tonight is going to present EPAM. So take it away, Mr. Lynch.
All right, thank you, Mark. And anyone who can spell realizes this is not CTSH. There are no common letters in the ticker or the name, but this is EPAM Systems. I'll show you on the next slide where it came from, but it is a technology high-growth company. You could see a pretty good record of up straight and parallel, although it is not covered widely by analysts and has been publicly traded for a shorter period of time than some of the other companies that we look at. Let's take a look at the next slide. I picked this up just from my fairly standard screen that I use with Manifest, which is roughly my par plus 5%, usually slightly under. You see that the sweet spot began at 10.1% when I ran this screen. I stuck par at 10%. Like I say, usually just a little below that. A couple of reasons for that. One thing, if you haven't picked it up on Manifest, is that the numbers shown on the actual dashboards or screening results are actually rounded to the 1 digit. And sometimes your screen, for example, Perigo, let's say that is 15.08 and it rounds to 15.1 at the bottom. If you had set your screen at 15.1, Perigo would not have shown up. And so that's another reason that you may want to set your, in fact, notice Mark shows two 15.1s. One is showing in the yellow and one is not. And again, that's because of rounding. So that's one reason that I actually set it a little below my minimum. But that's just an aside. And the company that popped up was EPAM at the very top. And of course, the obvious question that you may ask, is it too good to be true? And we'll talk a little bit about that as we go through the presentation. Next slide. Again, a benefit of Manifest Investing is that you can do quick industry comparisons, and I did that for EPAM systems, and you can see this particular slide is sorted by quality. I'm looking for the best of the best quality-wise in the industry. You see EPAM does rank very well quality-wise, and again, most of the companies here are probably not in what you would call the buy zone, with the exception of Simulations Plus, EPAM, and Monotype Imaging. Everything else is a bit on the high side, maybe Manhattan Associates. So EPAM certainly passed the quality screen with the company, and also good potential return. Next slide. Here's just an introduction if you're not familiar with the company. I was not familiar with it until it popped up on the screen. It's a leading technology consulting and actually programming and software engineering company. They do more of the actual hands-on programming than, say, an Infosys or a Cognizant or an Accenture, who are more on the consulting, although again, all of these companies are blending into various areas. Most analysts do not put EPAM as a peer with Cognizant or Infosys or the others. However, if you look at some of the company presentations and some of the industry business studies where they compare the quality of the businesses from a business standpoint, they do in fact bring in Cognizant and Infosys and Accenture and many of those other companies that you may be familiar with in the IT consulting area. So again, there's a lot of overlap there. One thing that is unique about this company, I don't believe I show it on any slides, but I'll just mention it, they tend to have much more of both a customer and in particular employee base in Eastern Europe, as opposed to the Indian connection that many of the other software consulting companies have. It's been around for 23 years. You can see it's quite geographically diverse. We'll see some more details on that. It's ranked number 8 on Forbes 25 fastest growing tech companies, and Fortune also ranks it high among IT fast growing companies. Next slide. This is just from a company presentation. Their fourth quarter reports. You can download it from the company website. It tells you again some of the same facts that were in the last slide, as well as a few others. Notice the revenue by geography, how it's spread. It is largely North American and Europe, but is diversified. See the services that they provide, both software as well as management and licensing consulting services, and they're pretty widely spread in their industries that they service. They're not quite as concentrated as some of the other IT consulting firms that we look at. Next slide. Again, this is just a slide showing both their spread, excuse me, their diversity of industries that they service, as well as their penetration. For example, they've got 5 of the 10 largest investment banks. Notice the life sciences and healthcare. They work with all of the top 10 pharma companies and so forth. So you can see that they are diversified both by industry as well as dealing with the top companies in the industries. Next slide. This is essentially a graphic view over time of what we've just been looking at as far as both the industry and the geography. The pie chart on the right shows you the breakout by industry, and you can see the revenue by geography. CIS is the Commonwealth of Independent States. That is the former Soviet bloc of countries. You see, as you can see here, they had a fair bit of business, but has been declining as a percentage, and they are picking up some Asian business. That's the APAC, Asia Pacific, but again, primarily Europe and North America. Next slide. This just gives you a little bit of a look at their client base and their numbers of clients and their percentage of business. An important thing to look at for smaller companies. You don't want to see or certainly you want to watch closer a company that has primarily 1 or 2 very large clients. And you can notice by the chart, which is the easiest way for me to see it, it's also in the graphs at the top, but I can see it better in the chart in the lower right hand corner. Notice their revenue streams, their large clients, they're saying 20 million and above, and then they break it down. But if you notice, they started in 2013 with 4 20 million plus clients. They're now up to 7. They've been slowly increasing each year. The next block down, again, they declined a little bit, but they're up again in their middle size clients. Then again in their median positions, they're growing every year, and then their smaller clients as well. So again, they're spreading their revenue along different size companies and different size clients, but they're growing in each of them, and then you can see they have some longevity in their top clients as well. Next slide. Again, something of concern to any global company, but frequently, again, software consulting companies, is currency. Again, largely dollar denominated, both revenue and expenses, but you can see they're relatively diversified, and you're able to do what I like to do when I invest in global companies, which is essentially ignore currency, because again, over the long haul it washes, and when you see a diverse mix of currency, you can tend to say that's what's going to happen. Next slide. This is the front of my stock selection guide, and I chose to use stock selection guide for this presentation rather than the Manifest Eagle, because I just wanted to show some of the graphs. Again, you see the relatively up, straight, and parallel that we looked at earlier, and I'm projecting a 20% sales growth, which is significantly under the consensus. I got that somewhat based on my gut looking at the latest numbers and so forth, but also the company is projecting for fiscal 2017 at least 20% growth. They are, as you can see, slightly slowing in growth in this particular slide, and that is, of course, what happens as companies get more mature. They turn from very high, fast-growing companies into what we would just call fast-growing companies. And the important thing is to figure out what is a reasonable level, and I've quite honestly decided to be a little bit beating up on, and I'm sorry that's a horrible sentence, a little bit pessimistic on this company, a little bit on that they're going to slow down rather rapidly in doing these projections, just to see what happened. Something that's interesting, and I can't fully figure it out, but notice the projected earnings for 2017 and 2018. Those are the two blue dots with E's out front. And Mark had shown projections in his figures as well. His line looked straighter than this. But I can't find any typos in that. But I believe what happens, this is a company that because they report, they have a lot of stock-based compensation, and so they report both GAAP numbers and non-GAAP numbers that vary significantly because of the stock-based compensation. And the best guess that I've come up with is those blue dots, the actual numbers, seem to track the company's guidance for non-GAAP earnings. And so I think there's just a disconnect in the services that report analysts such as Reuters and Finance Yahoo and all of the sources that I checked. Schwab, all are reporting earnings projections up there in that range, which is significantly above the company's GAAP earnings. But it does tend to show you that there's some potential for earnings growth from the analysts' thought. Next slide. This is my expected income statement using the 20% growth projection. I did choose to leave margins where they are at the current 12-month 11%. Margins have been declining slightly, but actually slower than the industry. If you compare the margins with the industry, they're above the industry average and are declining slower than the industry. Again, as they grow larger, that happens, as well as just more competition in the area. But I come up with projected earnings of $4.41 for the next 5 years. Next slide. Then PE ratio, you can see that PEs have been kind of all over the place as the market tends to discover EPAM systems, and they've been rising, although the growth has been slowing slightly. I just chose to use roughly the median PEs going forward, and all of that together gives me a projected return using an average PE ratio, which is the manifest methodology, of 10.7, which is significantly lower than manifest consensus-based return, but still a good solid potential return above my par given the current market, and also plenty of potential ability to be surprised should the company not slow quite as fast as my projections are allowing them to slow. So I add EPAM systems to the portfolio.
Yeah, that sounded different enough from Cognizant that we'll let you slide on that. All right, and again, we'll keep the floor open after we're finished here for any Q&A, and we can, if you want to fire some stuff off at Cy. One of the other things that I was thinking, Cy, is they did recently close a huge contract with UBS or somebody that is projected to possibly give a little bit of a step change in results, so some of that could be in there too. All right, Kim's unable to join us tonight. She's taking care of some family business, but her topic for tonight, and I'm just going to cover it briefly, is the notion of finding opportunities in spinoffs. And the list that you see in front of you is for the last little bit less than a year, some of the interesting spinoffs that have actually taken place, and they're ranked from highest to lowest return since the actual date of the spinoff. Here in Michigan, we noticed Fiat Chrysler spinning off Ferrari, and notice that that's up some 34.9%. The point is that there have been some outsized gains made by investing in some of these type of companies over the years. And again, it can be a little bit tough to get information. Sometimes you might have to rely on some pro forma stuff, but you can access some opportunity. She makes the point that, again, some of these spinoffs, like we saw it from many of the Biogen positions with BioVeritiv. Just as an example, they refer to these as child stocks that just kind of appear in your portfolio. And the spinoffs returning 700% during a 14-year period when the stock market went up 150%. And there you see some of the annual numbers from some of the S&P spinoff from one of the index we'll talk about here in a minute. And again, just so the notion that there could be some fairly interesting opportunity. In his book, You Can Be a Stock Market Genius, Greenblatt actually covers this as one of his areas of emphasis, in that he does monitor the realm of spinoffs and has, especially in the first 10 years, going back a couple of decades ago, I know that he had some spectacular returns deploying these types of strategies. If you go to Morningstar.com, you can actually enter the term spinoff into the box up at the top, and you get a pull down of a few funds that are specific to spinoffs. The Horizon Fund there, the Guggenheim Fund that Kim is bringing to our attention tonight, a couple of index funds, but actually drilling into the holdings of the one she's adding to the tracking portfolio tonight, you can actually see, well, there's BioVeritiv right at the top. If you drill into the holdings and then sort them by the time when they were added to the portfolio, to the CSD portfolio, you can see that over the last month or so, some potentially interesting stock studies have erupted. And again, they're not going to be covered, not out of the gate, most likely by Value Line. Value Line will pick up some of these, but if you dig in and do some study, chances are that could be an opportunity to also cherry pick, in addition to, if you want to go with just base loading up and watching the performance of the CSD. We'll certainly be doing that as a group here with the addition of that mutual fund. But again, this is actually an exchange traded fund. Again, opportunity could knock just in watching these over time and watching for potentially lucrative and rewarding spinoffs.
Mark, can you repeat again where you said BioVeritiv was spinoff from?
That's actually from Biogen, and fairly recently, for every 2 shares of Biogen, you received 1 share of BioVeritiv. The ticker on BioVeritiv is BIVV, and it just shows up in your portfolio. Many groundhog accounts had Biogen last year, so there are a bunch of people that benefited from the BioVeritiv. Cy picked Biogen a couple times last year, so he'll benefit from that. And again, I'm just pointing out Morningstar and these type of funds as in this type of a drill down into the holdings. Again, looking for what's been bought recently as a potential source of ideas. Anything else, Ken?
No, that answers the question, Mark.
I mean, I think the Hilton Grand Vacations, and I don't know what Conduent does, but could be just a few moments kicking around. We might find some of our small companies for next year in places like this, Ken. So again, just in conclusion, there's just a number of things. The book has an excellent section on the notion of spinoffs. There's a link to a site by Joe Cornell called Spinoff Research. Now, he runs a fairly expensive newsletter, but it also has a blog. And there's a stockspinoffs.com. So again, to try to stay abreast or aware of spinoffs happening. And again, she's seen some pretty successful stuff and sees it as a real opportunity. Kim will be doing a presentation. This is just one of the slides from the presentation at the Better Investing National Convention in Cincinnati in May. And you can see at the very top heading there, this is actually one of the slides, and she invites you to join her for the in-depth discussion of this realm of opportunity, see if it might make some sense for you. Okay, let's go ahead and press on. I think we're doing pretty much okay on time. I'm only going to take a couple minutes, Ken, and then you can kick in. I'm going to kick us off tonight with, again, my favorite screen when I go shopping for stocks. I do like to watch for opportunities within the portfolio, if at all possible, as Ken and Cy have both suggested. But I typically will go in and just search by manifest rank greater than 99.4. So what you're basically looking at, this rank is a composite that we build of the quality and the return forecast, the two of the three most important characteristics for any company. We basically blend the two, give them kind of equal weighting, and then give them a score. And we go looking for the top 1/2 of 1%. It's the only number on the screen that I use. And this is a place that I will literally go shopping if I'm looking to invest real money. Very interesting that Cy has been nibbling around here in recent months, places like Infosys Tech and EPAM, and he's gun shy about going back to Cognizant. Those companies are all showing up here, including Ken's eGov in the third position. The consulting area has really been beat up by the global recession, and there probably is some opportunity out there. I took a hard look at Cognizant tonight. I didn't think I could stand the abuse, or I might have brought it. But a good growth rate, good return, and that's been a good company for a long time. Don't be surprised if one of us doesn't bring it back as a repeat selection here in the not too distant future. But the company I'm going to go with is the one right up at the top, Synaptics. It's a company, it's a repeat selection. I've selected it prior, a few years ago. And Ken also selected this, bought it in 2010 and sold it in 2013 with a positive relative return. In other words, his transaction beat the market. So we have that one there, one closed position, one open position. So we'll be doing a double down on Synaptics. What do they do? It's just basically computer stuff and phone stuff and touch. They do some stuff with biometrics and touch screens, and they were basically the company behind putting the first pads on your keyboard of a laptop so that you could use that as the mouse. This is basically what they do. They look for places and situations and utensils and devices where they can help interface with computers and basically that Internet of Things that everybody talks about so much. These guys are trying to develop the stuff that is the interface point between humans and the cloud, if you will. And again, they cover a lot of stuff. I'm not going to go into any great level of detail. You can go to synaptics.com. Their investor relations site is awesome for getting a closer look at the company. But they're into all kinds of stuff, not just laptops, not just cell phones. Some of the stuff we were talking about NVIDIA earlier tonight with the three-dimensional goggles on the right there. Healthcare, it's a topic that Ken has talked about repeatedly, the telemetry of healthcare. In fact, he's going to be talking a little bit about that tonight. And these guys are represented in that business. Wearables, I have the Fitbit thing, and it goes with my Under Armour stuff, and I don't get it yet, but I will. Smart home stuff, they're in this type of, they're basically in the business of life and information interfacing. Here's a look at the company. Again, just fairly up, straight, and parallel. This is basically their complete operating history. They came public in the mid part of the last decade, and you can see that the price has been fairly steady, up and to the right. A little bit cause for concern at the far end of that graphic as the earnings have tailed off a little bit. That's what has caused a little bit of the price pressure, the downward price pressure here of late. But it's still a pretty good looking picture from where I sit. Again, here is the profitability in terms of net margin over their lifetime, and you can see this is what's causing some of the concern and the skittishness on Wall Street right now. They are maturing. They were no surprise. They were discovered right out of the box. The PE was high, and it's been settling in, getting more mature, settling into the low double digits as we would expect from a company like this. But again, and I'm looking at the overall picture and assuming a relatively modest growth rate of somewhere in that 11 to 12% range, first milestone, You can see that the margins, which have been fairly steady, I do expect them to do what Value Line is showing here and moderate and go back and achieve somewhere around the average or approach that trend. If that's the case, you're looking at 12 to 13% net margins. And again, PEs for this company are basically in that glide path landing zone of low double digits. Using those three assumptions, you basically come up with a return forecast in the mid to high teens, and that is consistent with Value Line's expectations on their low total return forecast in the low teens. So again, this is a situation where the company is being tested, and it's going through definitely some turbulence. They're very creative. They've been successful over the years. They're in a highly competitive environment that's going to have its bumps and turbulence. And I just think it's a decent situation to go ahead and double down and try to do fairly well. I'm going to spend just 1 minute on this slide. We've been putting together a few of these. I find these to be a little bit fascinating. What you're basically looking at is a 35 or 40 year stock selection guide. And I put together a couple pieces of work on Under Armour and Nike. Anybody care to guess the company that we're actually showing here, going back from 1984 and through the projections out to the year 2020? You can see that it was a company with fairly flat profitability and some bumpiness there, and then some fairly spectacular profitability over the last 10 years. Any guesses in the box, Ken, as to who this might be?
We're not getting any guesses, Mark.
It's not Bed Bath & Beyond. That was Ken's guess.
I'm going to guess Apple.
Oh, man. Cheater. It is Apple. And, you know, one of the reasons I bring this up here, and in the context of Synaptics, is because we're just talking about how they have these challenges. And, yeah, they have to come up, they have to win design competitions, and they have to, I mean, they're going through a point in their life cycle about 15, 20 years in that's just simply says they're being tested. Their metal's being tested. Well, here's Apple. And, again, notice the cycles. It hasn't been a straight path from A to B, but you are looking at a 15% growth trajectory over the long time history of this company, maybe down as low as 10 to 12% over the last few years. But what I had actually forgotten is they had years without earnings. You see them right here. And they had their moments. Remember the Lisa project. Remember that they had some stuff. There's some flat stock prices here. Talk plateaus. There's plateaus here, right? So again, it's not unusual for a technology company to be tested and to have their metal tested in a time frame like this. This is also a fairly dramatic illustration of, we talk about business model evolution and change. I mean, this is one company from here to here. They went through a transformation, and the profitability did this, and it's staying there. They basically got into the cell phone business. So you can see a dramatic transformation in business model. And then last but not least, many of us have always scratched our head over how this exciting, dramatic company that's widely followed by many of us and has a stronger growth rate than many people believe could have such a low PE over the years. And check this out. We're talking low teens for an average PE, including the trend. It's right there in front of us. It's never been the 60s or 80s that we saw from things like Cisco Systems. So my point in bringing this before the group is just basically say, I think these long-term SSGs could be quite informative in many cases, and things like illustrating that business model. But in the case of Synaptics and the situation they're in, pointing out that these type of companies do have moments when their metal is tested. It's nothing unusual. Find a good company with good leadership, good management, a good management report card, and have some faith. So we'll go ahead and add Synaptics to the tracking portfolio for the roundtable and hope for the best. Hopefully I can be as successful as Ken was with this position a few years ago.
Well, Mark, I'm taking a look now at MEDNAX. Here's the chronicle for MEDNAX. That's off the bottom of the home page, and that's the kind of quality line that I like to see for any company that I'm investing in. That's that blue line at the top that looks like it might be a margin line. Well, that's actually quality being graphed. and quality has stayed pretty consistent at 100 for quite a few years. I also like to look at a company that has been trading at places that are historically near the top of their range rather than near the bottom as far as return is concerned. And when I look at the last year and a half for MEDNAX and compare it to where it was 4 or 5 years ago, I certainly am looking at a company trading near the top of its range. My thesis is that we're not going to see nearly the dramatic changes in the healthcare system, at least not for the next 18 months to 2 years, 3 years, 4 years. President Trump just recently could be quoted as saying on television, "Who knew that changing the healthcare system would be so complicated?" Meanwhile, I'm sitting on the couch screaming, "I knew, and almost anybody else in the world knew." But it's going to be much more of a challenge, in my opinion, to change anything. Meanwhile, the healthcare stocks are not loved by anybody, so let's look at a healthcare stock with a really high quality that I happen to think has a chance of becoming quite profitable. Healthcare is in a constant evolution. Even before we elected a Republican Congress and a Republican president, we're talking about all kinds of different things that are changing the way healthcare is delivered. Healthcare used to be defined by how much you paid for it, and the new philosophy is, what are the outcomes? Maybe a doctor should get more reimbursement for keeping a patient healthy rather than just performing all kinds of tests that cost a significant amount of money. There's all kinds of changes going on in healthcare, and frankly, we don't know what these changes are going to lead us to or what they're going to look like, and MEDNAX is moving towards a change that makes a lot of sense to me, and we'll see if it has staying power to make some money for its investors. Next slide, Mark. MEDNAX originally operated in the pediatric and neonatal services industry. What they did was they collected groups of doctors, they put them onto teams, into businesses, and then they sold these groups of doctors to various hospitals. We had one of our investment club members who just had a baby that was born that was under 3 pounds, born significantly prematurely, and a MEDNAX neonatal team up in the Saginaw area was the team assigned to bring this baby to a place where he could go home and thrive, and that's exactly what he's doing now. He's home and he's thriving. But these doctors are no longer hired by the hospitals. They're hired by these teams, these companies, and then they contract with the hospitals and with a lot of other things. MEDNAX has moved big time into anesthesiology services, and now they're one of the primary deliverers of anesthetists to the healthcare system. They also have a large group of folks devoted to helping practices, medical practices, manage themselves with all kinds of software, all kinds of support systems, all kinds of tools to help doctors' practices run more efficiently. And the most recent addition to what they're doing, and the fastest growing, is this telemedicine, the one that I have circled down here in the bottom left-hand corner. Their biggest thing right now is with teleradiology. And what this really means is that MEDNAX has contracted, they have joined together a large group of radiologists that are stationed throughout the entire country. Each radiologist is licensed in a number of different states and can work in a number of different situations and has some different specialities. So instead of relying on the 1 or 2 or 5 or even 10 radiologists that might be in a local hospital, You work with MEDNAX and you send your x-ray to this group of thousands of radiologists. They identify the one that is the specialist in the type of x-ray they're reading. They get the x-ray read and they get the results back to the doctor that needs the information as quickly as they possibly can. It's a much better use of everybody's time, and it gets access to people that are really at the top of their field, even in fields where you might only see 3 or 4 x-rays of that type in any given month. When you multiply that by 50 states, and in fact they're moving all over North America, then you begin to see how efficient the whole thing is. MEDNAX third quarter earnings, for example, grew a little bit more slowly than they had anticipated because they weren't hiring these radiologists quickly enough to serve the demand that they had put in place for this service. That's kind of a good problem if you don't run out of radiologists to hire, and they haven't. They've since solved that issue. Next slide, Mark. They're positioned in lots of different specialties. You can see the specialties underneath the eye bars right there. In the last 20 years, 220 plus private physician practices have joined the MEDNAX team, but you can see that MEDNAX physicians are still an extremely small part of the entire business that deals with the particular specialties, which means that MEDNAX is positioned to really grow, and it is growing not only organically, it's doing a lot of organic growth, but it's also growing by acquisition. Click again, Mark, another slide. You can see most recently the acquisitions that of private practices when they're being sold. You can see that they're going in the majority to MEDNAX. There's the 4 best competitors to MEDNAX in the other 4 bars, but the dark blue bars show the number of private practice acquisitions made during that particular calendar year, and MEDNAX seems to have a lead on the pack and has maintained that lead for a reasonable amount of time. Next slide, Mark. This is teleradiology. This presentation, I've just drawn a few slides from a really interesting presentation on the MEDNAX website. If you want to learn more about what's going on here, go to their website, look under presentations. This particular one is less than a month old, and they put up a lot of presentations and then keep them really well service so that the information is very current. This teleradiology says that there's about 400 right now US-based radiologists providing service to over 2,000 facilities in the 50 states, DC, and Puerto Rico. Next slide, please, Mark. Neonatology, this is the working with premature babies, working with babies that need immediate medical attention when they're born, working with babies that are having eye problems, or one of the biggest problems, especially for babies born a little bit prematurely, is this necrotizing enterocolitis, which basically means they're having terrible problems bringing food through the digestive system. They've improved these processes, and the incidences of some of these things have been reduced in the last 5 years in their 100,000 babies campaign, and you can see the large percentage in reduction of these types of problems. So they're certainly demonstrating that they can make a real difference if you bring their teams onto the site to help with the neonatology. Next slide. And then anesthesiology is one of their fastest growing areas right now. Anesthesiologists are grouping together just like cardiologists have done, just like a lot of other specialists have done, and they're offering their services as a company or as a group to the hospital rather than being hired individually on the hospital staff. You can read more about that on the MEDNAX website. Next slide again. Here's the SSG, and I'm in an investment club, the Mid-Michigan Model Investment Club, that owns this stock. We've owned this stock for a reasonable period of time. And you can see that on first glance last Tuesday, when we looked at this SSG, the stock watcher for MEDNAX was a little concerned. You can see that we have lines that were continuing to move upwards, and they were really straight and they were fairly parallel, and then suddenly we have earnings kind of falling off in that last year. And while we wanted to buy the stock, it appeared as a buy on our SSG, and the manifest validated that SSG for us. We were concerned about why had the earnings suddenly fallen off. Well, to me, that's a signal right away when sales continue to move on trend, and when earnings move in a different direction, that's a signal to me that there might have been a one-time charge. So the first thing I did, click again, Mark, was I went to the top of the online tool and I clicked research, and then I clicked company website. Up came the top of the website. It's a little bit light, a little bit hard to read, but I've circled where it says investors, and I clicked there. New slide, Mark. And on the investors column, I don't know, 6 or 8 things down, it said non-GAAP financial. So I clicked there. Next slide. And up came a reconciliation of what was going on between the GAAP numbers, that's the generally accepted accounting practice numbers reported to the SEC, and the non-GAAP or adjusted numbers, they're sometimes called, or pro forma numbers, they're sometimes called, and up came those numbers. MEDNAX reported $3.49 in yearly earnings, that's the top circled number, but they made some adjustments to give me a non-GAAP number of $3.99. So what I chose to do was to adjust those numbers on an SSG that had been adjusting its numbers all along. So click again, please, Mark. I went back to the top of the tool, and this time I clicked on data up at the top, and a pull down menu came up, and I clicked on annual data. Next slide. And right here on the annual data sheet, you can see under EPS that $3.49 that was the GAAP number. I went in there and typed in $3.99 to adjust it. Click again. And look what happened to my earnings line. An earnings line that was troubling before the adjustment becomes on trend, and it maintains the trend that's been going on for 8 or 9 years, and it gives me a lot of confidence to go forward. Now, think about it for just a moment. If the end of that line for 2016 were where it was originally, and then you project it outward, you'd get a dot on the extreme right, that's the right-hand circle, that would be lower than the dot I had. So by adjusting the 2016 number, I also upped the adjusted earnings per share number 5 years from now. On top of that, by adjusting the earnings for 2016, I adjusted the PE ratios for 2016 wherever they might appear on the SSG, because the SSG uses this earnings number to calculate the PE ratio. So click again, Mark. When I finally put everything together, I get a buy, I got a better than 3-to-1 upside downside, and I got a projected average PE return of about 10.6%. Click again, Mark. Here I am using the Eagle from MEDNAX. The 3 numbers with squares I adjusted from Mark's consensus values, and I lowered the sales growth to 11. I lowered the number of shares to the value line 3 to 5 year estimate of 92 million, and I adjusted the PE just slightly, the average PE number, to that 15. Notice what I get then when I do those adjustments. I get a par value of 10. You know, that's as close as I'm going to get for between an SSG and a par. One gives validity to the other. One tells me that I have confidence in the other, and I don't care which direction I start. I like to work on both of them to see if they're going to come up in the same ballpark. These did. I'm very pleased to add another holding of MEDNAX with about a 10 to 11% return, we hope, to the portfolio. And that's Roxy seconding the motion.
Roxy seconds. Okay,
Yes.
now, Hugh is actually here. I don't see his name on the attendee list, Ken. Can you double check for me? He's dialing in. I don't know if that makes any difference.
Okay, just hold on a second.
And while Ken is trying to retrieve him, this is just simply for those of you in the audience, just a quick look at the 52-week low proximity screen that he often will favor. I just added a couple things, double-digit growth and double-digit return forecast. And,
well, Mark, if he's dialing in, he has not actually dialed into the webinar because he's not on the list.
yeah, he says he's here, but I don't see the name, so I can't figure it out either. So everybody say hello, wave a cyber hand at Hugh, I guess.
Hi, Hugh.
Hello, Hugh. I don't see you either.
So anyhow, here's just a quick list. And notice that many of the companies we've talked about in recent months, from Under Armour to Edwards came up at one point, Perrigo, Synaptics is on that list tonight. Chipotle, kind of interesting. He says hello back. So I don't know why it's not, he just said hello on my cell phone. So he's here. He's here and he's accepting all the praise and taking a bow. So just using his methodology, which seems to have some merit based on the results we've seen over the last 7 years.
What's his alias? He must be under an alias.
It must be an alias, yeah. He probably travels under one or something. So anyhow, we are running up against the 9:45, so I think we better go ahead with the poll, Ken.
Okay, if you give me just a moment, Mark, I'll get that ready to go here.
By the way, there's the evidence from last year's roundtable that Stifel only got 5% of the votes. The second best performing selection in the history of the roundtable. Some of you get coal in your stockings. In the 5%, you know who you are.
And here we are. You can choose EPAM systems. You can choose the stock that Kim was going to present tonight. It's actually an ETF called Guggenheim Spinoff ETF, or MEDNAX, or Synaptics, or none of the above. You just use your mouse to click on the one you think you might want, or if you have a touch screen, touch the one you think you might want to choose. We'll try to get maybe 90% of you voting. We're up to 84%.
I'll ask Hugh for his vote.
Doesn't cost you anything to vote, folks, so just give us a vote if you would. I'm going to count down in my mind from 10 and then close it. We're at 86% voting. Okay, I'm going to close the poll. And 87% of our audience voted, Mark. And here are the results. So we'll add a double position in MEDNAX, okay?
I think there are three good choices. Let's hope that they all work out well.
I'm going to close that now so we can go back to your screen, Mark. If you give me just a moment.
Yeah, and we can do it in a session. Just a quick reminder, I know Ken was already talking about the fact that we'll both be in Tulsa this coming weekend. But Ken will also be in Florida in April, Kansas City in April, and then we have a conference coming up in Minneapolis in May prior to the National Convention in Cincinnati, and all four of us will be there in addition to Kim Butcher and a few others in Cincinnati. Should be a good time, a good event.
Mark, we do have some, are you still there, Mark?
Yes, I am.
Okay, we do have some questions. You want to close the thing down and we'll take the questions then?
Okay.